Investing is all about finding the right balance between risk and reward, but knowing where to draw the line can be tricky. In this video, I'll break down how to assess your risk tolerance, diversify your portfolio, and make smart decisions that protect your money while aiming for solid growth. Whether you're cautious or adventurous, mastering this balance is key to long-term investing success. Let's dive into how you can invest smarter and sleep better at night. Today we will talk about how to balance risk and reward in investing. So before we start, make sure to hit the like button and subscribe to my channel. 1. Understanding risk and reward. Investing always involves a trade-off between risk and reward. Risk refers to the possibility that your investment could lose value or fail to meet your expectations. Reward, on the other hand, is the potential financial gain from your investment. Generally, investments with higher expected returns come with greater risks, such as more volatility or the chance of loss. Conversely, safer investments tend to offer more modest returns. Balancing these two forces is crucial to building a portfolio that meets your financial goals without exposing you to undue stress or losses. Understanding this dynamic helps you make smarter choices about where to allocate your money. It's important to recognize your personal tolerance for risk, as everyone's comfort level and financial situation differ. Risk isn't inherently bad. It's the price paid for the opportunity to grow wealth. However, too much risk can lead to anxiety and poor decisions, while too little risk may prevent you from reaching your goals. Finding the right balance is about aligning your investments with your time horizon objectives and willingness to accept fluctuations in value. 2. Assess your risk tolerance. Before constructing your portfolio, you must assess your risk tolerance, how much volatility and potential loss you can emotionally and financially withstand. This varies from person to person and can change over time. Factors influencing risk tolerance include your age, income stability, financial goals, and investment experience. Younger investors with decades until retirement can usually tolerate more risk because they have time to recover from downturns. Conversely, retirees or those nearing financial goals often prefer less risk to protect their capital. Assessing your risk tolerance honestly helps you avoid panic selling during market dips or missing out on growth opportunities by being overly cautious. Many investors take questionnaires or consult financial advisors to better understand the risk profile. Once you know your tolerance, you can choose asset allocations that balance stocks, bonds, and other investments accordingly. This tailored approach helps maintain discipline and prevents emotional decision-making. Remember, your risk tolerance isn't static. It's wise to revisit and adjust it as your life circumstances change. 3. Diversification. The key to risk management. One of the most effective ways to balance risk and reward is diversification, spreading investments across different asset classes, industries, and geographic regions. By diversifying, you reduce the impact of any single investment's poor performance on your overall portfolio. For example, stocks offer growth but can be volatile, while bonds typically provide steady income with less risk. Adding real estate, commodities, or international exposure further reduces portfolio risk. Diversification doesn't guarantee against losses, but it smooths out returns over time and can protect you during market downturns. Using diversified ETFs or mutual funds makes this strategy easy and affordable for most investors. Proper diversification helps you capture upside potential in multiple areas while avoiding concentration risk, putting too much money into one company, sector, or country. It also reduces emotional stress by making your portfolio less susceptible to shocks. Regularly reviewing and rebalancing your portfolio ensures it stays aligned with your risk tolerance and investment goals. Ultimately, diversification is a foundational principle in balancing risk and reward effectively. 4. Asset allocation and its role. Asset allocation refers to how you distribute your investments among major asset classes like stocks, bonds, and cash. It's one of the most important decisions in managing risk and reward. A higher allocation to stocks generally means higher growth potential, but more volatility. More bonds and cash lower risk, but also reduce expected returns. The right allocation depends on your investment goals, timeline, and risk tolerance. Younger investors might have 80 to 90% in stocks to maximize growth, while retirees may shift to 30 to 50% stocks to preserve capital and generate income. Some investors use target date funds that automatically adjust allocations over time. Regular rebalancing, selling assets that have grown beyond target weights and buying those that lag, helps maintain your desired risk level. Asset allocation affects nearly 90% of portfolio returns according to some studies, making it a critical tool for balancing risk and reward. By thoughtfully allocating assets, you create a portfolio designed to meet your needs and avoid overexposure to any one type of risk. 5. Understanding volatility and managing it. Volatility is a measure of how much investment prices fluctuate over time. While volatility can present opportunities to buy low and sell high, it also represents risk. Sudden drops in value can be unsettling and lead to poor decisions. Different asset classes have varying levels of volatility. Stocks are generally more volatile than bonds, while cash is the least volatile. Understanding your portfolio's volatility helps set realistic expectations about how much your investments might swing in value. If you can tolerate higher volatility, you might enjoy greater rewards over time, but you must be prepared for the emotional roller coaster. Conversely, low volatility investments offer steadier returns but may limit growth. Techniques like diversification, asset allocation, and using bonds or dividend-paying stocks can help manage volatility. 6. The role of time horizon. Your investment time horizon. The length of time you expect to hold investments before needing the money is a key factor in balancing risk and reward. Longer time horizons typically allow for greater risk-taking since there is time to recover from market downturns. For example, someone investing for retirement 30 years away can afford to invest heavily in stocks, which have higher volatility but greater growth potential. Conversely, if you need funds within a few years, reserving capital becomes more important, favoring bonds or cash equivalents. Matching your asset allocation to your time horizon helps ensure you're not taking on excessive risk that could jeopardize your goals. Regularly reviewing your horizon as life changes, such as retirement, buying a home, or funding education, helps you adjust risk levels appropriately. 7. Behavioral discipline. Avoid emotional investing. Balancing risk and reward is as much about mindset as it is about numbers. Emotional investing, making decisions based on fear, greed, or panic, can lead to buying high and selling low, undermining your long-term success. Behavioral discipline means sticking to your plan regardless of short-term market fluctuations. Developing a well-thought-out investment strategy based on your goals, risk tolerance, and asset allocation creates a roadmap to follow. Regularly reviewing your portfolio and rebalancing when necessary ensures your investments stay aligned with your risk level. During market downturns, it's crucial to resist panic selling or chasing hot trends. Likewise, during market booms, avoid becoming overly aggressive out of greed. Using automated investing strategies or working with a financial advisor can help keep emotions in check. But if you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.